Today, we will talk about financing, what it means and why it matters. Financing is the process of providing funds for business activities, making purchases, or investing. Financial institutions, such as banks, are in the business of providing capital to businesses, consumers, and investors to help them achieve their goals. The use of financing is vital in any economic system, as it allows companies to purchase products out of their immediate reach. This is done by leveraging the time value of money to put future expected money flows to use for projects started today. There are two main types of financing available for companies: debt financing and equity financing. Debt is a loan that must be paid back often with interest, but it is typically cheaper than raising capital because of tax deduction considerations. Equity does not need to be paid back, but it relinquishes ownership stakes to the shareholder. Both debt and equity have their advantages and disadvantages. Equity is another word for ownership in a company. For example, the owner of a grocery store chain needs to grow operations. Instead of debt, the owner would like to sell a 10% stake in the company for $100,000, valuing the firm at $1 million. Companies like to sell equity because the investor bears all the risk. If the business fails, the investor gets nothing. But at the same time, giving up equity is giving up some control. Equity investors want to have a say in how the company is operated, especially in difficult times, and are often entitled to votes based on the number of shares held. Some investors are happy with growth in the form of share price appreciation. They want the share price to go up. Other investors are looking for principal protection and income in the form of regular dividends. Most people are familiar with debt as a form of financing because they have car loans or mortgages. Debt is also a common form of financing for new businesses. Debt financing must be repaid, and lenders want to be paid a rate of interest in exchange for the use of their money. Some lenders require collateral. Debt is easier to obtain for small amounts of cash needed for specific assets, especially if the asset can be used as collateral. While debt must be paid back even in difficult times, the company retains ownership and control over business operations. The weighted average cost of capital is the average of the costs of all types of financing, each of which is weighted by its proportionate use in a given situation. By taking a weighted average in this way, one can determine how much interest a company owes for each dollar it finances. Provided a company is expected to perform well, you can usually obtain debt financing at a lower effective cost. For example, if you run a small business and need $40,000 of financing, you can either take out a $40,000 bank loan at a 10% interest rate, or you can sell a 25% stake in your business to your neighbor for $40,000. If you took the bank loan, your interest expense would be $4,000, leaving you with $16,000 in profit. Conversely, had you used equity financing, you would have zero debt, and as a result, no interest expense, but would keep only 75% of your profit, the other 25% being owned by your neighbor. Equity financing comes with a risk premium because if a company goes bankrupt, creditors are repaid in full before equity shareholders receive anything. Raising capital through selling equity shares means that the company hands over some of its ownership to those investors. Equity financing is also typically more expensive than debt. However, with equity there is no debt that needs to be repaid and the firm does not need to allocate cash to making regular interest payments. This can give new companies extra freedom to operate and expand. With debt, either via loan or a bond, the company has to make interest payments to creditors and ultimately return the balance of the loan. However, the company does not give up any ownership control to those lenders. Moreover, debt financing is often cheaper since the creditors can claim the firm's assets if it defaults. Interest payments of debts are also often tax-deductible for the company. Many businesses eventually need greater spending power in order to grow, and financing is the most common method of attaining it. There are pros and cons to both debt and equity financing, and each company should carefully weigh the costs of each before making a decision. Here are 5 key takeaways. 1. Financing is the process of funding business activities, making purchases, or investments. 2. There are 2 types of financing: equity financing and debt financing. 3. The main advantage of equity financing is that there is no obligation to repay the money acquired through it. Equity financing places no additional financial burden on the company, though the downside is quite large. 4. Debt financing tends to be cheaper and comes with tax breaks. However, large debt burdens can lead to default and credit risk. 5. The weighted average cost of capital, WACC, gives a clear picture of a firm's total cost of financing. Hope this would help. Thanks for watching.